this is your financial instruments revision page. Again, now you will remember when you look at the middle of your screen, IFRS 9 recognition, our financial liabilities can either be 1 at amortization or 2 at fair value through profit or loss. Therefore, we are now within this one. Now, when we look at this at fair value through profit or loss, next block on the right side with a blue block around this. If we have our at fair value through profit or loss, remember this, guys, on initial recognition. At fair value, the fair value gain or loss due to credit risks will be recognized in your OCI. The remaining fair value gain or loss will go to your profit or loss. Okay, now guys, don't stress about this. Back to basics. Focus on this one. This will be your easy marks. Okay, then subsequent measurement. Remember, subsequent measurement will be future at year end. If we have our financial liability at fair value through OCI, elected, designated, remember they've indicated this to us, subsequent changes should be separated into fair value changes due to changes in credit risk of the issuer. Remember, our issuer in this question is BB. Recognized in OCI and accumulated in equity. And then other risks in profit or loss. You with me on this one? Of the issuer. Therefore, if we were able to identify that there is risks, increase, decrease, relating to the issuer, then that portion will be going to our OCI. And the other risks will be in our profit or loss. Now, when you refer to the scenario, you will identify that there's no specific details in terms of movements in the credit risk. This is only included in our requirement part B. Therefore, this relates only, remember when the indicators, this is CC and now the risk will change to triple B. Triple C to triple B. Therefore, this is not relevant to this section. Therefore, we only have to focus on this other risk. Therefore, we now know when you look at your timeline that the movement in our carrying amount and our fair value will be recognized in our profit and loss. Okay. Now, let's get back to our journals. When you look at our timeline, we need to include our journal on 1 October 20.18. You're still with me on this? And we need to remember our transaction costs. Therefore, our journal on 1 October 20.18 will be our normal journal, which we have identified already, guys. When you look at this, we have identified debit bank, credit financial liability, and credit our equity. Now, let's include this. I've included this to save us some recording time. When you look at the screen, 1 October 20.18, we debit our bank, we credit our debenture, the liability. And we have calculated this, but guys, remember, you need to indicate to your marker where did you calculate this, right? Therefore, let's indicate here, when you look at the left side of your screen, that this will be my calculation number 1. And within 1, I'm going to state that this is 1.1. Now, guys, don't confuse your marker with your steps, please. Okay, I've highlighted this orange. I'm pretty sure my marker will be able to identify this, right? Then I have my equity component. This will be my calculation 1.2. And my calculation 1.2, I credit my equity component. And this will be in my statement of changes in equity. Now, my next step, I have identified that I need to allocate my transaction costs. Now, I'm going to call this then, when you look at my screen, middle of the screen, my calculation number 2. Now, I know that they've indicated to me 3% of the face value. Therefore, this will be the 150 million, which is my face value, times 3%, and this will be 4500,000. Right? Now we need to allocate this proportionately. Now, guys, think about this. If this is transaction costs, they had to pay this. Therefore, they had to credit the bank. We need to allocate this. Therefore, this will be the 4.5 million times 147,499,340 on our total 150 million. And this will be an allocation of 4424,980. And we will have to determine our balancing figure, which will be allocated to equity. This will be allocated to our financial liability and our equity portion. Therefore, deduct the 4.5 million, and our equity portion will be 75020. Then we need to allocate this. Remember, but when you refer to your financial instruments revision page for me, not that one, guys, sorry. Okay, here. Step number 4, guys, transaction costs. If we make use of pink here, left, middle, sort of. Step 4, you need to remember financial assets, liabilities at fair value through profit or loss. Your transaction costs should be expensed. Guys, do you see? It should be expensed. Therefore, in our journal, we will have to debit this in our profit and loss. When you look at the left side of your screen at the bottom, I've included a second journal entry. We will have to debit, important, look at this, debit the transaction costs of our financial asset at fair value through profit or loss, and this will be included in our profit and loss. And we have calculated this amount, guys, 4424,980. And we need to indicate that this is in my calculation number 2. I've highlighted this pink. I'm pretty sure my marker will be able to follow. And then the 75020. Debit this to equity component in our statement of changes in equity. This is a debit. And we need to credit our bank account with a 4.5 million. Right? Include that all of this is in my calculation number 2. Now, when you look at our timeline, what is our next step? We have included our initial journal entry on 1 October 2018. We've included our transaction. But on our timeline, we still have to recognize, important, the payment for this period. Remember, the payment for this period, the actual cash outflow, the money that will be paid. Look at this, right? And when you look at your step number 2 on the left side of your screen, you will remember that we did calculate the payment value, and this will be the 3528750. But remember, this is quarterly. I'm going to indicate that this will be my calculation 1.3 for my marker to be able to identify. Therefore, if we need to recognize the payment, we will have to debit the, what, guys? Remember, at fair value. A fair value adjustment in our P&L. Credit our bank. Guys, I'm going to be honest with you. This account, I would rather call payment interest. But it relates to this financial liability. Therefore, this will be an adjustment in our P&L. 3.5 million times 4. Now, do you see, guys? Not the same as our financial liability at amortized costs. No allocation to the liability in the statement of financial position. When you look at the right side of your screen, I've included my third journal, and I have debited. Now look at this, guys, important. Debit the fair value adjustment. Now, guys, I'm going to be honest, if you call this the interest relating to your financial liability in your profit and loss, because this is technically interest being paid, you will still receive your marks, right? And the solution, therefore, 3528.75, this is included in my calculation, 1.3 times 4, and this will be my payment, 14.1 million. Identify that this is not the same as your financial liability at amortized costs. Okay, now look at your timeline for me. What is our next step? Our next step is that we need to determine the fair value adjustment at year end, because remember now that our liability has to be recognized at fair value at year end and the records of BB. Currently, what is the carrying amount? If you look at all of our journal entries, what is our carrying amount? Our carrying amount remains the same, 147,499,340. Now, why did the carrying amount remain the same? When you look at the journal entries, we did not post anything to this liability. Therefore, we now need to determine what is the fair value of this liability at year end.